Alright mate, imagine you've got $100,000 sitting in your bank account right now. The question is, what do you do with it? Because the decision you make today could have a massive impact on where you end up financially over the next 20 years. Do you put it into the Australian share market and let compounding quietly do its thing? Or do you use it as a deposit on an investment property and take advantage of leverage in Australia's housing market? Now here's the thing, both paths have created plenty of millionaires, both have die-hard supporters, and both sides will tell you their strategy is the best way to build wealth. But today we're putting them head-to-head. No hype, no property guru promises, no stock market fanboys, just realistic numbers and one simple question. If two Aussies start with the exact same $100,000 today, who comes out ahead 20 years from now? So let's meet our investors. Investor A takes the full $100,000 and puts it into a diversified portfolio of Australian shares and ETFs. Investor B takes that same $100,000 and uses it as a 20% deposit on a $500,000 investment property. Both hold for 20 years, both stay disciplined, and neither tries to time the market. So what happens? Well, let's start with shares. A lot of people underestimate the share market because honestly it's a bit boring. There's no auction day excitement, no renovations, no tenants calling you at inconvenient times. You basically invest and wait, but boring can be incredibly profitable. Historically, the Australian share market has returned around 9 to 10% a year when dividends are included. Doesn't sound life-changing at first, but compounding is where things get interesting. At around 9% a year, that $100,000 grows to roughly $237,000 after 10 years. Pretty nice. But leave it alone for another decade and suddenly you're sitting on around $560,000 without adding another dollar. No tenants, no repairs, no headaches, just patience and time doing the heavy lifting. And there are a few extra perks too. Australia has one of the most investor-friendly dividend systems in the world thanks to franking credits, which can help improve your after-tax returns. Add low costs, instant diversification and the flexibility to buy or sell whenever you want. And it's easy to see why so many Australians build serious wealth through shares alone. So after 20 years, our share investor has turned $100,000 into roughly $560,000. That's the number to beat. Now let's look at property. Property has one huge advantage that shares simply can't match: leverage. In the share market, your $100,000 usually buys $100,000 worth of investments. In property, that same $100,000 can control a $500,000 asset. That's a big difference, because growth is based on the value of the property, not the size of your deposit. If a $500,000 property goes up by 5%, that's a $25,000 gain, not on a $500,000 investment, on a $100,000 deposit. That's why leverage is so powerful and why property has created so much wealth across Australia. So let's run the numbers. Our investor buys a $500,000 property that grows at 5% per year. After 10 years, it's worth about $814,000. After 20 years, it's worth more than $1.3 million. At first glance, it looks like property absolutely smashed shares. Game over, right? Well, not quite, because that $1.3 million figure is only part of the story. Over those 20 years, the property investor has also paid mortgage interest, insurance, council rates, maintenance, property management fees, possible vacancy periods, and probably a few expensive surprises along the way. Meanwhile, the share investor has mostly been sitting back, reinvesting dividends and paying very little in ongoing costs. So the real question isn't which asset grew more. The real question is which investor actually kept more money after all the costs were taken into account. And that's where things get a lot more interesting, so let's settle this like a championship fight. Round 1, liquidity. Shares win. Need cash tomorrow? You can sell part of your portfolio in minutes. Selling a property can take weeks or months. Round 2, diversification. Shares win again. One ETF can give you exposure to hundreds of businesses across different industries, while most property investors start with one asset in one location. Round 3, simplicity. Shares take it. No tenants, no maintenance, no repair bills, and no property managers. For a lot of people, that's a huge advantage. Round 4, leverage. Property wins this one comfortably. It's property's secret weapon. Round 5, wealth acceleration. Property wins again because leverage can dramatically increase returns when things go well. Round 6, tangible ownership. Another point to property. Many people simply like owning something they can see and walk through. Round 7, passive income. We'll call this one a draw. Shares pay dividends, property pays rent, and both can generate ongoing income. So where does that leave us? 3 rounds to shares, 3 rounds to property, and 1 draw. Which means the winner comes down to the final category: risk. Interest rates can have a huge impact on property investors. Higher rates mean higher borrowing costs and tighter cash flow. For share investors, rates can affect company profits and market valuations. The point is, neither investment exists in isolation. The economic environment matters, but even risk isn't what ultimately decides who wins. The biggest factor is behavior, the thing hardly anyone talks about. Most investors don't fail because they picked the wrong asset. They fail because they panic. They buy when everyone is excited, sell when everyone is scared, chase trends and constantly change strategies. The investor who steadily contributes to a diversified share portfolio for 20 years will usually do better than someone jumping from one hot idea to the next. And the property investor who buys quality assets and holds them through multiple market cycles often beats the person trying to perfectly time every boom and bust. That's why the answer to the shares versus property debate isn't nearly as exciting as people want it to be. If we're talking pure upside, property probably has the edge because leverage can amplify returns. If we're talking risk-adjusted returns, shares often come out ahead because they're diversified, flexible, and easier to manage. But for the average Aussie, the best investment is usually the one they can stick with for 20 years without giving up. Because the biggest threat to building wealth isn't a market crash, a housing downturn, or even a recession. It's abandoning the plan halfway through. And that's exactly why many wealthy Australians eventually own both. Property gives them leverage, shares give them diversification, and together they create a stronger overall portfolio. So after all the calculations, all the forecasts, and all the debates, here's the takeaway. 20 years from now, most Australians won't regret choosing shares over property or property over shares. They'll regret waiting too long to start. Because compounding doesn't care whether you choose shares or property. It only cares how long you stay invested. And the earlier you start, the harder it works for you. If you got value out of this video, give it a like, subscribe to the channel, and turn on notifications so you don't miss future Australian investing videos. Thanks for watching, mate, and I'll catch you in the next one.